Welcome back, everyone. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi, everyone.
Thank you for joining us. Today, we're going to do a very interesting topic because it deals with money and how we would invest. So the question here is, how would you invest $100,000 right now? So this is, as of now, it's May 2024. Markets always change. So at this point, we just want to share our opinion of how we would invest $100,000. So before we jump into the details, just some assumptions. All of us here are 30s and 40s. We already own a home. We have families.
Yep.
So your personal situation might be different. You may be saving up to buy a home and all that. So that's different. But this is our personal situation, and this is how we would invest $100,000.
No one size fits all.
Yeah. So you need to tailor this, but this is how we would look at the markets right now, and how we would allocate this $100,000. So why don't we get the ball rolling?
Yep. So how would I deploy my $100,000 now? Okay. So now first take out $100, buy 40.
Yeah. I was gonna say that
over the next few months, not one time, right?
There's a total subscription, right?
Oh, really?
Yeah.
I
Just
didn't know
go
that.
to the Singapore Pools app. I actually subscribe.
Oh.
You never know. I mean, you can just subscribe to 10 draws and whatever amount you want. I've never won anything.
Okay. Yeah. Anyway, that's gambling. So you need to put a minuscule of the portfolio, very small percentage, 0.01% for that. Okay. That's more like for fun.
Yeah.
Right. And other than that, I think a bulk of it will still have to go into equity. Right. I mean, equity has proven that over the long run, it has, I think, outperformed the overall market. And I mean, generally, if you compare to bonds and other instruments, equity is the one that actually has the best in terms of performance. Okay, so I'm still an equity guy, so I'll put 100% on equity. All right, eventually. But right now, I mean, given the situation, the market condition that we are looking at, I think it's difficult to deploy everything right now because if you look at US, it's not that cheap right now. Okay, so what I would do now is, of course, 50%. I will park my money on the fixed income, even though I said that I don't invest in that, but it's still important to put it there. And Singapore, fortunately, we have this Singapore saving bonds, right? And that currently is giving, at the time of this recording, is about 3.3%, above 3%, which is quite decent. Versus if I were to compare, put it in the bank, it's going to get less than 1%, right? So that amount I will put into the Singapore saving bonds, and I can withdraw it anytime. Right, without any penalty. Right, of course, there's a lead time of up to 30 days, depending on when you withdraw it. Right, so but they still pay you interest in on the amounts that actually accrued to you. Okay, so that's the best thing about Singapore saving bond. Right, so that 50K will goes to Singapore saving bonds, and then the other 50K you can you have to open a brokerage account first, right? Then you transfer the money into your brokerage account. Right, and that money, obviously, you will earn some form of interest rate depending on which broker that you use. If you are using IBKR, there is a pass-through interest rate that they get. Okay, so depending on the currency that you have, I think in Singapore right now, you could potentially earn up to 2.9% if the amount is above 14,000. All right, that's for IBKR. All right, but if you're using other brokers, like for example FSM1, they do have this auto sweep accounts, which you can actually park your money there, you sweep it in, and then it's going to give you 3.2% right now at the time of this recording. So at least you are making the money to work while you are finding ideas to invest, right? So now you sweep it in. Of course, now you have to go out and find ideas, right? So, and you are lucky you come here because we have a few ideas that we have discussed, I think, over the last few roundtables. I think we have brought up, I think, Capo DC. Right, so if you have missed that episode, please go and watch it. We talk a lot more about Capo DC, the valuation, and right now at the time of this recording, Capo DC is still pretty attractive, right? So I don't mind allocating 5% there, right? So this 100,000 portfolio, I will split it into 20 stocks equally.
Okay.
Right, of course, on the actual deployment, you might not get the exact 5%. Sometimes it's like 5.5, sometimes 4.5 is okay. Right, so right now, if I base on that sizing 3,000 share, based on $1.73, I think it's going to give me 5.2% allocation. And then I think we also had another roundtable that we talk about Mapletree Pan Asia, right? So because the share price has plunged so much, and we also did another roundtable on this, but I don't want to go into the details. But basically, this is also another REITs that I don't mind having exposure in, because both of them, the share price are currently quite depressed, and they own quality assets. Okay, so you have a life exposure in data centers, retail shopping mall in Singapore, offices, and most of them are grade A offices, and a bit of exposure in Hong Kong, China, and Japan. Okay, so these two will give you that, right? And at the same time, these two will give you very stable dividends. So those are the two dividend stocks that I will have. Okay, so that 10%, right? And then the other 15% I will look at Hong Kong. Right? So Hong Kong right now is very cheap. Okay, so if you have like first time have never invested in Hong Kong before, obviously you will like be overwhelmed by a lot of companies and a lot of information that you need to go through, right? So the best way to have exposure in Hong Kong, let's say if you're comfortable with the country, the currency risk and all that stuff, I think you can look at this tracker fund, right? So this one, MIMBIC, HSI, right? The top 30 constituents now is a lot wider in terms of diversification. But that will give you exposure into companies like Tencent, HSBC Holding, Alibaba, AIA, Meituan, China Construction Group, China Mobile, and a few others, right? So these are the top 10 holdings that they have, right? And the funds, the expense ratio for this fund is only 0.08%. I think it's very, very efficient. And Hong Kong is also well known for the tax efficient structure that they have. No capital gain tax, no withholding, dividend withholding tax, right? So then I will put 10% there, right? Because the valuation in China is very attractive, right? And then of course I will particularly want to have more exposure in my favorite company, which we also discussed I think a few while back, which is Tencent, right? So that one lot will give me a 6.6% exposure in the portfolio. So overall I already deployed 25%, and then the other 25%, okay, I want to have exposure in the US market because US has a lot of great companies out there, right? If you don't know which one, of course you can just tag along with S&P 500, right? But S&P 500 right now, the valuations are a little bit high, so I'm just standing on the fence, on the side, waiting for the opportunity to come before I deploy this 25%. So that money will be in the brokerage account, auto sweep, all right, money market funds, earn good interest rate, and then the other 50% standby for like another big crisis like what we saw with 2020 COVID crash or 0809. I feel that nowadays crises are getting shorter and shorter, so it may happen anytime. Okay, so yeah, so that is how I will deploy it. I mean, of course, if you ask the same question back in 2022, right, what would you do with your $100,000? I would say now you can straight deploy in the US. And we did a session on this, I think in the middle of 2022, where we talk about the mama, right? Meta, Apple, Microsoft, Alphabet, and Amazon. And at the time the valuation was reasonable. I think in fact it's come down a lot because of the 2022 crash. And we did a discussion on like what would you do with that $10,000 allocation, right? And we actually sorted out, okay, and based on the price that we had at the time, okay. And today, as I went back and calculate 2 years later, wow, the return is like average 75%.
Pretty good. So it just goes to show if you go in at the right time.
Yes.
I mean, based on value, not because you're trying to predict the market, because it was cheap then.
Yes.
Based on the valuations, and you just
value compared to the price.
Correct. Yeah.
So if you will give me the same valuation metrics, like the valuation multiple that US had at the time in 2022, I'll tell you that the other 25%, I will straight away go to the US, fully deployed. But now, because the opportunities are not there, so I will just sit on the fence and wait.
Okay. So just to summarize, you will put some in Singapore for dividends, some exposure to Hong Kong, China, because it's cheap. You like Tencent particularly, so you have an extra allocation for that because you like that company. And then 25% into the US, maybe an ETF. But not the best. It's not expensive, not cheap right now.
When you talk about ETF, of course, it's not the SPY. It's like CSPX, right? Where the most efficient in terms of tax structure. And we did discuss this, right?
So my question is, so when you finish the 25%, only then, I mean, then you would wait for more opportunities to use the 50% that's in your
then I will be even more selective in terms of opportunity. I mean, I always like to compare my current portfolio. If none of them is better than the one that I have, then I might as well just buy the existing one.
So you just expand the portfolio in the same allocation instead of buying new stocks. Would you say that? And of course, if I come across new stock that are very good, I don't mind increasing it to 11 stock, 12, 13, 14, and I will find it over time. And this deployment of $100,000 portfolio, it will not be like immediately, right? It takes time. Right? I mean, we have learned a lesson, if you were to deploy everything during the bull market, like especially right now in the US,
you might knock yourself when the market crash, and then you have no capital to deploy. And that's where the 50% will comes in.
Okay.
Right, we'll take advantage of this. Right,
Yeah.
whichever crisis they are, it could be something in particular sector, right, a particular company that you can actually go in and take advantage.
Yeah, I think that's a really good point. So I remember reading questions like this sometimes on Reddit, Singapore Reddit and stuff like that. Say, hey, I got $100,000, I was left an inheritance and stuff. What should I do with the money? Because it's their first time having like, you know, a 6-figure sum, for example. And there are a lot of opinions, but I think the best ones are always the more prudent ones. You know, take your time. You don't have to rush in straight away, because it can get really exciting to just go like, I want to deploy the money straight away and start earning the returns straight away. But no, it's not as simple as that.
I think you must know the market valuation.
Yeah.
Your cash position fluctuate with the market valuation. As the market goes cheaper, right, your cash position should be lower.
Yeah.
As the market get expensive, like the US market right now, your cash position should be more, you know, should buff up the position.
Okay.
Right.
So this is Rusmin's take on how you would deploy $100,000. Again, no recommendation to buy or sell anything. All the stocks or REITs that we mentioned are really just for, you know, educational purposes. Please do your due diligence. Whether it fits your risk profile, your investment goals, it's all entirely personal because it's different. So this is from your point of view, what you're comfortable with, what you like. So Tencent is one example. You like it, some people may not like it. But yeah, it really depends on you. So this is Rusmin's take. Let's listen to Victor's one.
I got a slightly different perspective from Rusmin. I mean, depending on your age, right? So there's two things regarding you want to grow your wealth or you want to preserve wealth, right? Usually, I think the 20 portfolio or 25 stock portfolio is more for preserving of wealth, right? If you're starting with $100,000, right, and you want to make another $100,000, it's a double up, right? But if in the law of large number, right, you just need a 1 million portfolio and grow by 10%, you got $100,000. So I think a $1 million plus portfolio using a 20 stock makes more sense, right? But I feel if you are a younger age, you're lower capital, let's say 100,000, I think you should concentrate your portfolio to maybe 5 to 8 stocks. Right? Depending on the situation and all this, right? You hold a more concentrated portfolio, but equal weightage, right? So Rusmin says that 20 stock equal weightage. Your 5-8 stock equal weightage is also the same probability. The only difference is that this portfolio tend to be more volatile. Right? Right. The key is that in the event where you make a mistake, right, you should maintain the percentage. A lot of people, when they concentrate a portfolio, they make a mistake, which is what we do in the past, right? We scared, then we go back to a lower. Then it takes you very hard to bounce back. But if you concentrate the portfolio, you continue maintain even though you make a mistake, right? Eventually you'll bounce back very fast. Right? So I got a very different perspective because I think that if you want to grow your wealth with a lower capital, right, you should concentrate your portfolio on the best ideas. Right. Preferably, I think 5 lah, maybe 20% each and all this. And you rank them according to the risks and rewards and also the intrinsic value and all this. Right. So if I have the portfolio right now, definitely I won't be going to the US because the US markets are high. But of course, there's selective stocks that in the US with sort of like situation play, right, that can invest right now. But in general, the most one, they are mostly on the high side, I would say. Right. So I would likely take the portfolio goes to the Hong Kong market, where there's more maybe 100 stone I flip, I can get maybe 20 to 30 stones that is like of proper values and proper spread, right? So you spread through sectors and you spread through the different types of companies, right? I think for me is I tend to my portfolio currently also is quite concentrated, and I got majority of my position in the I still have US stocks, but it's just only 1 or 2, but I got more in the Hong Kong markets.
Alright. So you're just more of a concentrated situational play, turnaround kind of investor. Is that something?
Turnaround, I wouldn't say turnaround, but probably I look at situation and I feel that this situation is temporary. I will tend to buy into those I feel is temporary. But of course, you need to assess yourself. Right. So to do this concentrated portfolio, right, you really need to know what are you doing. Okay. It's not everybody can do it because when you just start out investing, right, can you be sure that you're always right? Nobody can be sure, because you still don't know. Your encyclopedia of the knowledge of the stock market is just this size, right? But as you invest long and you review on your mistake, you'll grow your encyclopedia. So once you grow your encyclopedia, right, you'll tend to see patterns in situations that this situation happens in this company, and after that what happened, right? And you can bring that situation to another company, right? So I think this is I've seen you have to go and build your encyclopedia, right, to do this concentrated portfolio. If you cannot, then I think maybe you start off with 10 or 15 stocks. It's a good start already.
Okay, so this is something that if someone has more experience in the stock market, they've gone through like many cycles and situations with companies that, hey, this is the same situation that's happening in another industry, maybe the same outcome will happen there, and you invest that way. So for someone who's a beginner, not recommended. Would you say that, like, not recommended for someone who's a beginner? Because it takes time, right? To
because when you use, if you are a beginner, I also feel you should start off with a concentrated portfolio. Because let's say if you got a 10K portfolio, you cannot be investing into 20 stocks, right? It don't make sense. So that one stock go up 100%, it don't move the needle. So your 10K portfolio should invest in 3 stocks, right? And of course, along the way, when you work, you will put in money, that portion will drop. And that's also how I started also. A much concentrated portfolio, and when the situation turned out well, it really bring up my wealth up also. So
there could be like 2 schools of thought. Someone would say, hey, someone who's new should just invest something more diversified, like an ETF. Just 500 stocks straight away, right? And then you learn along the way. But for you prefer just diving off, going straight into deep end, and just like getting your feet wet and then learning.
It's not really getting feet wet, because if you stay at the same percentage weightage, right, it is the same as you holding a 20 stock portfolio. It's just that it's much volatile.
Yeah, that's the thing. So it's more volatile. So let's say you pick a particular one out of 5 stocks, one of them just goes wrong. How do you know you made a mistake there? How would you tell?
I will tell is when first I'll go back to the initial thesis lah. Why did I buy into the stock? So if the thesis is no longer valid, then I will sell. Right? Or if sort of like a new event that affected the stock that breaks the thesis also, I also will sell also. So that's how I usually look at it.
So basically, it's not because the price went against you.
No.
It has to be whether the fundamentals went against you. The fundamentals went against you. The thesis went wrong and stuff like that.
I think we have whole stock before that we are down 50%. After that, the next few years it just went up 3 times.
Back up. Meta is a good example.
Meta is a good example.
It went up 3 times from the price we bought, right? Even though we didn't average down. Right? You get me?
So what are the risks for someone using your strategy? Like common things to look out for, just in general.
I think if you want to do this strategy, your emotion has to be you have to be very clear that the equal weightage, right? The portfolio is going to be volatile. So this one you must accept the fact, right? But every time, if let's say you invest 5, 2 is wrong, 3 is correct, you are still having a high win rate, right? But then the 2 down may affect your portfolio and may affect your emotion. But you must understand that when you clear off that position, right, when you reinvest again, the percentage of the portfolio in terms of the cost price weightage must still be the same. Right. So if your portfolio becomes smaller, the weightage also of the reinvestment also must be smaller. So you go by the percentage, right?
So I think basically the portfolio allocation, the way we split across different stocks is to reduce the portfolio risk in the event when there's a company that got into trouble, right? It could be macro issue, it could be company specific issue. Diversification will help you to reduce the amount of loss that you have in the particular company, right? So that's the purpose of diversification, right? So in the past I've seen people diversifying into 15 REITs. They are one single sector. Although within REITs itself there are many subsectors, but they are all prone to interest rate fluctuation. Right. So when I look at the portfolio, this is not diversification. This is just you are too into REITs, which is not good, right? When the interest rate at the time was all-time low, so I told that person, I mean the maximum that personally I'll be comfortable. Let's say if I really want income, I like the REITs type of yield, right? Maximum I'll go is 50%. I'll never even go above that, right? Ideally, max I will go personally 30%.
Yeah.
And then of course you want to hatch it with the banks, right? Which is they also sensitive to interest rate, but at least they hedge against one another, against the REITs, right? At least you have a portfolio where, for retirees, this two exposure will help to hedge against the interest rate. But over long term, these two assets will still outperform, right? Because of the inflation, the nature of inflation that we have.
Yeah. Okay. I think diversification is a huge point.
Yep.
So for me, you don't want to make the mistake of falling in love with one particular stock and then going like 50%. Because I made that mistake a long time ago. I shared it on a YouTube short, I think, or Instagram short, where I lost a lot of money on Citigroup. And my thesis at that point is that Citigroup is not going to go away, and I was right. It's still around today, right?
And Buffett bought it also.
Yeah, but it never went back to that peak. Even though after it dropped 50% from the peak, and I got in there, it went all the way to like $1 or something like that.
Wow. Went
Went back up to like $3 max. Today it's $30, but it's because of a reverse split, 10-1.
Okay, share consolidation.
Yeah, so the thesis, my thesis was correct. Citibank is still here making money, but my valuation was just totally wrong. I lost money.
Yeah, valuation is very important.
Very important. So I didn't fully understand what I was doing. But anyway, I was young. When you're young, you can make mistakes like that.
Yeah,
you still have active income. You make it back. It's fine. Okay. But yeah, painful lesson. Diversification is so important. So for me, how I would invest 100,000 right now. First, like I would say, I'll buy a little bit of hope for fun. No harm in that. And in Singapore anyway, even if you lose the money, it goes to charity in a sense.
Yes.
Right? So it's okay. $8,000 I'll put in CPF for me. Yeah, I just want to reduce my taxes, put it into a 4% basically bond basically. The rest of it is actually very similar to what you're doing. I like dividend stocks, so I think the Capital DC REIT and Impact have good yield at this point in time. So I like Singapore REITs. The banks are interesting to me as well. And then for the US, I would typically just go with an ETF, like a CSPX or something like that. If you're into the whole world, VWRA is another example. And then I would pick particular companies that I really like to invest in. So I'm not so much into hunting like you like to look for situations and companies. I feel like that's not my thing. Unless I really like the company, I like following it, I kind of really fully understand it, then I might allocate a percentage to that. Maybe like how you feel about Tencent. Yeah. If not, I'm just going to go with an ETF. That's how I would invest. Yeah. So that's the way I would do it. So you can tell that investing is actually very personal.
Very personal.
Yeah, very different. All of philosophies are pretty much the same. Concepts, values, investing, about the same. But how we have our portfolios is very different as well. So again, it all comes down to what your investment goals are, what you like, what you don't like.
And it's also shaped through experience, I think.
Yeah, that's true. That's true.
What you have actually seen the possibility.
Yeah.
Right. For me, I've seen or read, if you go and look at Buffett, Joe Greenblatt, all these top investors who actually generate very high returns, they tend to have more concentrated portfolio. So it really depends on how you absorb your knowledge, and it shapes you in your character. That you believe that this is the right way. For me, is I have read it, I've seen it, I met a few concentrated investors, and I talk to them, and I see the results, and it makes me think that this is possible.
Yeah, I think it's super possible. I think it takes a level of skill that not a lot of people want to sacrifice their time for. I think you're one of the few that actually like it and want to do it, and you get results out of that. For me, I just want to, I don't know, play my video games or something. Do something else.
But the sad thing about this portfolio is that you have to be very patient. You cannot very eager to deploy. Most of the time you should be having cash, but when the right idea come, you go in. But it's not like, I see it now, I go in. It's not. You keep hunting, and when we hunt, we are hunting for the lowest risk with the highest reward. The risk reward ratio must be high. So when I do a certain bet, I make sure that it's 1 to 3 times, not 1 to 2 times. That means when it flips, it really 3 times, 4 times. Right. So you have to be very, very clear and really hunt for the opportunity, not just every time the market crash, you just go in like that. Right. So that's another step. I would say the other side of this cons of this style.
yeah.
I think the most common mistake is really like if you have $100,000, a lot of times people just want to deploy it.
Yeah.
Right. Like what you mentioned.
Yeah.
But I learned this the hard way, so I think you should take it slowly to deploy. Right. If you can't find ideas or this idea, meh, right? Well, after you go through, it's like, then don't do.
Yeah.
Right. Don't do anything is a decision by itself. Don't need to be like buy or sell. Right. So. This is very important that I just want to remind you guys. Yeah.
Okay. So I hope that was really helpful for anyone who's watching this, because if you have a sum of money you don't know what to do. I mean, nowadays you have so many ways to just park it somewhere, earn some interest.
Yep.
Yeah.
It's okay. You're still getting paid to wait.
Yeah.
Some money is still coming in, and then you take the time to go find something.
I
to
think
invest
every
in.
methods it works. It just goes to the same direction. That's all. It's
Okay.
whether you reach it fast or reach it slow.
Yeah.
That's all. Yeah.
But right now, if we are in a deep crisis, US, China, of course, I will tell you that 80% of it will deploy right away.
You're just like that.
Then I'll just have with 20%. Yeah, pump.
Okay.
But now, because we are not in the terrible crisis or what, except those that in China, so I feel that should still have more cash and wait.
Okay. All right. So maybe we can do a similar topic again in a different time.
Yep.
Yeah.
And then we'll share again so we can see how this goes.
Yeah.
But the last one was in 2022, right?
2022.
Yeah.
Yeah.
And we did something like that. It was 10K. Now we're doing 100K because of inflation.
Yeah.
Everyone's money is going up. But yeah. Okay. So I hope that was really helpful. Again, no recommendation to buy or sell anything. This is just for educational purposes. Please do your own due diligence. What makes sense for you. Entirely personal. Okay. So with that, I think that's pretty much it, right, guys?
Yep.
All right. My name is Adam. Roseman.
Thank you.
Thank you for watching, joining us here. Any questions about this, we're happy to answer them in the comment section. Of course, please hit the like button. Really help us with the recommendations on YouTube. And of course, subscribe to our channel. Many more roundtables coming up, and we'll see you again.